Well, howdy, folks. It's Mike again, and this is going to be a very good one, I think, very helpful. We are doing a back to the beginning or back to the basics on how I like to buy in and around a moving average. So, we're going to focus on 21 days and 50 days because that's what I use. But you can use the same technique on on any moving average. It's not the only way to buy off of a moving average. It's just the way that I like to buy off a moving average. So I'm going to walk through basically how I do it, some alternative ways of doing it that other folks are very successful at, but we're going to focus primarily on how I do it. Now, this Back to the Basics series is really, targeted. I try to not go off on tangents and don't do the music thing at the end, don't talk about the channel and all that stuff, just so we can get going on things. And I'm going to do several more of these, and then we're going to get back into the normal full-length episodes. But anyways, let's get going with this. I'm going to share a market surge, and let's make sure this is working properly. Okay, so what I did is I just did a custom screen, very simple custom screen, and just price greater than 25 bucks. Originally had a lower dollar volume figure in there and then increased it to that. And then just over the last 12 months was up, 25% or more. And I just played through all of these just to try to get some examples. And that's something that you should do as well. And just look through and look for stocks that had uptrends and test out your strategy for buying around moving averages through those, and you'll learn a ton from that. And what you'll learn is there's no one perfect method. So that's why I'm just going to walk you through my method. What I did is, as I went through all of these, I just flagged by hitting the F5 button anything that I thought was interesting, and that's what we have, this little flag thing on there. You just hit the little F5 button, or you just click it on. So I use the F5. So let's go into my flag symbols over here, and let's just go by what was up the most in the last 12 months, and we'll do those. We're probably not going to do all of these, but I just they were just some examples to go through. So I'm going to minimize this. So this is Rocket Lab. Really, this is way too aggressive for most folks to trade, but I'm just using this as an example. And probably a good time to just say, like, I'm not an investment advisor. I can't give any investment advice. This is not investment advice. This is just me trying to help you out, just sharing what I've learned. And if you have trouble sleeping at night, you can use this. So the thought process with buying around a moving average is, for me, is buying something that is in an uptrend. You're not buying it in a moving average, off the moving average on something that is in a downtrend. That is a recipe for disaster, or even flat. It is basically something's had a big move up or starting to move up and then pulls back in a normal and natural, healthy way into a moving average. And if you study prior winners, which you can through the Webby Rambles on Model Book series, which I would highly suggest watching all of those, actually several times. And you'll see what's normal and natural. And then if you look at stocks that didn't have big moves, you'll see what's abnormal action is. So anyways, the key thing is that you are in an uptrend. So how do you recognize that something's in an uptrend? Some basic ways. One, are you above your moving averages? Are you above your 200-day, which is this black line? Are you above? I'll blow this up a little bit. The black line is your 200-day. Are you above that? If not, you're in a downtrend. Is your 50-day above your 200-day? The 50-day is the red line. If you're not, you're probably in a downtrend. And if the green line is, which is the 21-day exponential, is underneath any of those, well, you might be a redneck. That you might be in a sideways chop or in a downtrend. So you don't want to use this. It's really when your 21-day is above your 50 and your 50 is above your 200. Are there exceptions? Of course, but just as a general rule, if this is something new for you, that's one of the things. And then, is it above its most recent kind of key breakout? So with Rocket Lab, here was your kind of key breakout that you were above. And we're going to be focused in on this pullback. So is it above it? Yes, it is. Whereas if we were looking at it over here, let's just go back there before we do this. And we're going to look on this day, February. So here, as it's pulling back into its 50-day, it's really underneath a key area. Like this was your kind of key breakout area that it was struggling with. Tried to break above it, failed. Tried to break above it, failed. Tried to break above it, and it's failing. So it's really sideways chop, but yet your 21-day is still above your 50 and your 50 is still above your 200. So it has that going for it. But also your RS line, in most cases, it'll be at least above your Grateful Dead line, which is this line here, your blue line. If you don't know what I'm talking about with that, go back and watch the Webby Rambles on the Quicksand Grateful Dead. So let's just go forward a week. And you can see that was just in a weak position. So you don't want to be buying into a moving average that is flat, in a flat or declining area, or is just pulling back in and underneath a pivot area. Yes, there will be a lot of them that work out, but in my opinion, it's out of position. Whereas down over here, let's just go there. Let's see, October 31st. And this is what you should do as you go through that screen, is just go and see different examples and just do a change date to them, because it looks so different when you do a change date. So here it is, not buying a $5 stock, but here it is just for example. It's above this key area, which was this pivot area in here. And now we're up there. Your 21-day green line is above your 50, 50 is above your 200-day, and it's pulling back into the 21-day, and you have your closing range ends up being very key. So you have a high closing range, 66%. Could it be higher? Absolutely. In fact, I'd prefer it to be higher. But this is your first sign that it's getting support at your 21-day. So if you like to buy early, this is where you might be buying some. Now, I'm going to wait for it to take out that high there, just because it's not as high of a closing range as I would have wanted. And frankly, I would think, and I know that it doesn't do this because we just saw what happened. I'm thinking it'll probably come into $10 and test that. So I don't want to buy in that weakness. And let's just go forward a day, and you'll see, boom, it doesn't have that further weakness. So I'm going to be buying it on this day as it takes out that high. That's my way of buying. As we go through some of these examples, you're going to see ones where I would buy on the first day that it touches the 21-day, but not in this case. Now, if you wanted to buy it on this day, is there anything wrong with it? No, because as long as you use that low as your stop, as your maximum stop, there's nothing wrong with that, in my opinion. And you'll actually have a better risk reward in some ways buying it on this day, because your absolute stop loss is closer than when I would be buying it here as it takes out those highs. So there's a risk reward on there. But the way I look at this is, now that it's recovered off of here, my expectation is for it to move higher. Whereas if I would have been buying it on this day, your expectation is it might go higher. Does it have to go higher? No, it could go here. That would be fine. It could go here. That would be fine. It could even go here, and that would actually be normal. So if you look at enough of these, you'll know what's normal and natural, and you don't want to use hindsight to play games with your mind and just find all of the perfect ones. And you can see this one over here. Let's just go there. 9 on a terrible day. So here, and again, I don't buy stocks under $10, but this just happens to be the example. So it breaks out of this cup with handle there, finds support at the top of that base, which is normal and natural, is in and around its 21 day, but I'm going to wait for it to take out that high there before I'm going to buy. I just want that further evidence. Now, if you buy on weakness, you might be buying it down here and getting some really good prices. Like I know people who do a great job of that and buy it in there. That's just not me, because if you buy it there and it comes into your 50 day right there, maybe you want to buy some more. But what's the problem there? Averaging down. And the reason why I buy the way I buy is I just look at averaging down as the worst thing in the market that you could do. Some people can get away with it. Most people, it's kind of the recipe for blowing up your account is by averaging down. And so, it goes all the way back to the Livermore days. And Bill wouldn't average down intentionally. If I ever average down, it's unintentional. And so the reason why I don't like buying in the weakness is because I just have a serious problem with averaging down. If I bought it here, why do I want to buy it more here, even if I've got a really good exit? Because now I've got the 50 day. So if you're wired where you can average down, well, your odds are probably stacked against you being successful. I know some really successful people that can average down, but most people can't. Just being frank. So do whatever you want. But I think it's a recipe for blowing up your account eventually. And so let's just move forward here. So then it does exactly what you expect it to do. The other thing of buying it, waiting for it to take out that high, is this is your clear expectation. It should happen right away. So you get that feedback from the market. Whereas if you're buying it in this weakness, you might have to let it dilly-dally around for a week, maybe even 2 weeks before you know that you're wrong, and be patient with a losing trade that you've averaged down in. And that's a very uncomfortable. I've tried that. I tried to rewire myself to be able to do that. And it was some of the worst trading I've done in my entire life, if not the worst trading, trying to do that. So don't try to, change your stripes, just like find your stripes and then build rules around that. If you're wired to buy weakness and average down and sit with a losing trade, then, I'm happy for you, but that's not me. It ain't me, babe. Somebody said that once. Okay, so now let's go to where my point was, which was this recent one. And as of this recording on September 1st, I don't have a position in it. I might have one tomorrow, but as of right now, I don't think I have a position in it. Let me just open up my account real quick just to see. I should probably edit this out, but I probably won't because, that takes time and all. No, I do not have a position. So anyways, probably should. But so this comes in to your 50 day. Let's go over here to the 19th. Just walk through this. So if you're of the mindset that, hey, this is a position that you already have and you want to add to it, well, that's a little different. But we're talking kind of today about starting a brand new position. Because if you have an existing position and you're adding it on to the weakness, that's a totally different thing. That's fine, because you're not averaging down. If your cost basis is down here and you're buying some in here, that's fine. But if you're flat going into it here, you're buying something that the assumption is it's going to probably come somewhere in this range. And for how long, you don't know. And it could come all the way down there. And at what point do you know that you're wrong? Well, you're wrong when you hit your max loss, which is 7 or 8%. And look, it went down 9% on that one day. So I'm going to want to put the odds in my favor and wait for something. So I'm not buying it here, but I am buying it here. Not in a huge way, but it did defend the 50 day. And now I have something to trade against, which is the low there. And it's back above its 50 day. And you've got a 3% closing range. Again, if it was at the absolute top, it would be 100%. Let's look at the day before. Day before, it closed at the lows, closing range of 0. That's as bad as it gets, obviously. You can only have less than 0 in movies. So here we've got our line in the sand. Now, your risk is actually more than that. Your risk is a gap down, because in this position, if you do it a lot, you're going to realize you could get a lot of gap downs here, and they happen more than you'd think. So I wouldn't be buying a ton here, but what I would do is buy a little bit here with the assumption that if it gets up to here, basically going through those lows, I'm going to add some more. And it doesn't quite get up there, but now that it's least as low as above its 50-day, I'm probably going to add a little bit more. I just know myself. You want to ask yourself, what would you do? Now, what do I not like about this? Well, the RS line is in a relatively weak position because it's down here near its Grateful Dead signal, and it's underneath its shorter term one. But that happens on pullbacks to moving averages, especially to a 50-day. So that's another thing you want to study. So here I'm going to be gunning it because now your RS line is back above its short-term moving average, and you're back above your 21-day. Your low held your 50-day for 2 days in a row, and you have some lower cost basis stock. So let's say about a 2.5% position here. Maybe I'm making a 7.5% position there. So I do a reverse pyramid, like 2.5 goes to 7.5, whereas Bill would always do it fewer shares, at least that's how he would teach. But if you study his work, it's a little different. That's a topic for another day. So now what you want to do is study these, what happens afterwards. Well, just ask yourself, if you start off with let's say a 15% position in a stock and you end up with a 200% position in that same stock, meaning 100% on full margin, well, by definition, you didn't pyramid, right? Because were you buying fewer shares along the way? Take you 2 years. So anyways, it is what it is. So this now is how it should act. Now, it doesn't mean it's going to continue to act strong, but at least you've got some in here and then some there, and then when you're wrong, especially if it starts coming into there, you start backing away, and certainly if it comes over there, backing away more. So let's go to our next stock in here, Palantir. Okay, I was looking at this one earlier, and I think there were some good examples in 24. Let's just go back a year. Okay, all right, this is a great example. So in and around here, that's a weak position. Now, forget that we know that it failed. Let's just go, let's go on 725. So, yes, your 21 is above your 50 is above your 200, it has that going for it, but you are underneath your pivot. So that's not a pullback to the 50-day. That's failing down to your 50-day, and your 21-day isn't even above your pivot. So it's not a pullback into it. It's failing at this point. That's just really what it's doing. Could it work out? Absolutely. Are you going to feel like a genius if you buy it here and it goes up? Absolutely. But I'm going to wait for at least the 2750. That's just my style. Not the only style. That looks better. And this is why I'm not doing it, because at this point, it's still above the low. Like your stop loss always has to be the low of your upside reversal. So you're just in no man's land. What do you do there? Do you buy it? I mean, do you sell it? I don't know. I just don't know. That's why I don't want to put myself in that situation. Still just not doing anything, right. But if you bought it on this day, you don't have enough evidence to sell it until it really takes out that low. So it's just dead money at risk. And then you get that gap down, and then you kind of have to sell it. And buying it there if you got away with it, well, you got lucky, man. Dude, I don't want to hear it. You got lucky, because don't tell me everything that you know about the company that you're buying on balance gap downs underneath the 50-day that's underneath the pivot. Study it. It's not going to work out well for you. But you can cherry pick a few examples. Okay, then it gets a lot worse. So if you did buy it there, how are you surviving through that? Because it got support at the 200-day? Really? Come on now. Be honest. And then you get a downside reversal. Wow, what a mess. Let's just go out a couple months. So this is why it's good to go back and study these, because, if you can put yourself in that position, you learn a ton, So here's another one. Now look at the difference here. Now your 21 day is above your breakout day. That's like a key thing. Now it's pulling into your 21 day and it's getting support. And let's go to this day, 9-4. Now that looks really good. And if you don't see that it looks really good, just keep looking at it until you see all the things. So what does it have going for it? Well, clearly defined little downtrend there, sitting above this, sitting above its 50-day, trying to find support in and around its 21-day. Its RS line is above its moving averages and above its recent lows. And more importantly, it shook out below this low, which, if you had tried it before, there's nothing wrong with trying it there or adding to it there or buying it there, that those people are shaken out. Because if that's your stop as your low of the day, which it should be, well, you got to honor that, right? And then you could say that you're going to wait until if it undercuts the low of an upside reversal day, that you're going to wait until the close of that day. That's hard, because when it works out, it's going to reinforce that you should always do that. But sometimes they just keep going and going and going down, and you have to have some sort of line in the sand. So if you're in that position, like if you're in it on this day and you'd bought it over here, what you can do is do a TWAP, a time-weighted average price order, to sell into the close. So let's say in the morning it's down here, and you let your broker know that, okay, I want to sell my position until the close. Now, as the day goes on, as if it's firming up, you could cancel that order and put a stop loss order in at the low of that day. Or you can just cancel it completely. You can cancel it and buy those shares back that you bought. It gives you that flexibility. Now, not all brokers offer that. I do trade through Interactive Broker, as well as TradeStation. They don't pay me to say this, but you can. I really like all the options that Interactive Broker has for their algo trades, and the TWAP is one that I use often for that, and it helps you from just selling at that bottom tick. And what you can do is, let's say you're on a day like this day and you've got that TWAP in, that bad day there, that early on, and let's say it's only around here early on, and you do a TWAP to the close. Once it starts getting worse, you can just say, forget it, just market order, or just get me done in an hour. Just modify the order that way. But anyways, so we're talking here, this is where I would be buying it because of all the reasons why we talked about. And now my line in the sand is right there. And if it goes above here, I'm going to add to it because I'm going to pyramid into it. Not really what you want to see, but it's not doing anything wrong. There it is on a Friday. That's kind of funky, honestly, because it tried to go and it couldn't go. So I've got it on a short leash here. Let's go out a week, see how this plays out. Not a fan of, just really wasn't a fan of that. Even knowing, I knew what happened because we had just looked at the chart a couple minutes ago. I knew it gapped up, but you want to be intellectually honest with yourself and don't just say, oh, these are all the good things about it because it gaps up the next day. I knew it gapped up the next day, but still, like, look, that's a weak closing range, 54% closing range when it was coming up against that area of resistance right where it should have moved and it took out the highs of those days. That's not what you like to see, but for whatever reason, it gaps up the next day. And so what I'm going to be doing is gunning it there, because if I'm in a position and it gaps up, I'm going to I know people who sell into that, and they're right to do it because that's their style. For me, I found that if I have a position and I get a gap up in almost all cases, I will just automatically add to my position and go out a week. It's acting nicely, and so on. So that was Palantir. Shoot, we're running low on time. Let's see what other ones. You guys could see these and see which ones you want to do. Let's go to RCL, which I do think as of this recording, I have a position in, but still. So round here, let's go back over here on 8-1. It looked like it was trying to get support in and around its 50-day. So some people might want to buy some there, and I could totally see that. And then, but your line in the sand is a low of that day, or also like kind of a time-based one. Like if it doesn't, because they don't always come all the way into the moving average. Sometimes they come into it very close because everyone's waiting for it to undercut, and it doesn't happen, and then it moves up. So that easily could have happened there, but it just didn't. So if I would have bought some there, by this time I would have been just worn out of it, waiting for a better entry. Now on this day here, this is why I don't like buying the weakness on, let's go to 8-8. If you buy it here, thinking, okay, it's in around $300, it should get support here. That's totally logical. But look at that RS line is crashing through. Like, why does it have to go up? It doesn't have to go up. It could easily base build and come into here and form the left side of a cup. If you've studied enough of these, I mean, you could say the same thing over here as it was coming in. Oh, it's overdone. It undercut the lows of this area. It should turn and move up, especially like on this day here. The reality is lots of times, I mean, look, that's 41% deep base, and those happen all the time. Well, that was a bear market, more like 15 to 25% would be more like normal. So I would say in this range. Didn't do the math. But let's go forward a day. So now this is your day that if you do, I don't typically buy underneath the 50-day, but if you were, now you have a line in the sand. Buying there, totally legitimate. I could see that. I might even bend it a little bit and nibble there, but really I'm not going to do anything material underneath the 50-day. It's just, I know me. But there, that's where I'm going to gun it, because now I'm going to use the low of this day as my stop. My expectation is for it to go higher. And so I would have a low of this day as a partial stop with this as my final stop. So I'm not that far away from it, and just wanting to gun it. And so let's go forward. Yeah, that's not ideal. That's really not ideal, but it's hugging the 50-day. So while I had gunned it, I would probably actually back away from a little bit of it just because I'm worried about it wanting to undercut that. Let's go forward. Boom. Got to add to it. So that's my style, because now my expectation is that it wants to be a magnet for up there. And excuse me, that's where I like gunning it when my clear expectation is for it to go higher, where I know people that are very successful that would just say, you know what, they're going to get much better prices. They could start buying it here, add to 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 it here, and add more here and add some more here. And they've got much better cost basis than I do, but you have to be wired that way to do that. Don't fight how you're wired, but learn how you're wired. You might be wired that way. And oh shoot, it's 30 minutes. Let's just do one more. Which one do you guys want to do? Well, let's do NVIDIA, because yeah, it's one that everyone loves. So let's go back and do this historically. Let's just go back. Let's go back another year. See if we can find some. Okay, there's some good examples in there. Where was it that I was seeing? Well, let's look at a few of these. Okay, let's go back to February. Okay, so it's broken out of this. Moving averages are stacked in the right place. Coming in. Okay, so it gets support right at its 21 day, and its 21 day is above its basing area. So you could be buying some there. I'm not going to buy some there. I could use hindsight and say, oh, I put my entire account in there and then it gaps up the next day, but I'm not going to do that. I'm going to really wait for it to take out the high of that day and the high of that day. But there, if it gives you an entry, you've got to ask yourself, are you willing to buy that gap up or not? I'm going to. In fact, it reminds me of Qualcomm back when Bill was trading it, and there was one that I did on this WRO model book one on this one, and it was right in there on 421 of 99, where you get this big gap up through. And of course, you would have wanted to buy it there as it was getting support in and around its 21 day and through its 21 day with that as your line in the sand, the low of that day. And you don't know that it's going to gap up, but then on that gap up, just adding to it. But it does come back in and kind of test that area. There's your gap up, and it tests it a month later. So it wasn't as easy as it looks, because if you bought up there, you're underwater. But let's go back to NVIDIA. And where were we? 2023, I think. So we were there. Okay, let's look over here. This is a little bit more normal. Okay, let's go back one more day. All right, so this is a typical pullback to your 21 day. Comes into your 21 day. This is classic. Upside reversal there, closes near your upper half. Now you've got a line in the sand at that low, so you're going to buy some there. Add to it there because it's meeting your expectations. Probably add to it a little bit there. Add to it there because it's Wolfgang's birthday. No, because it takes out the highs there. Just seeing if you're paying attention. And let's go out to the end of the month. And it just moves higher. Let's take this 1 month at a time, see if we can find some other examples. Let's go out just a few months. Okay, form this like ascending base type of thing. Let's go out to the end of the year. Okay, this is interesting in here where it pulled back in 8, 9. So some people would be looking at this saying this is a gift, right? Because it's your first real pullback to your 50-day or 10-week line on your weekly after it's uptrend. And I would agree with that. But I don't like how it's doing it here. It's really kind of crashing into your 50. So I'm going to want to wait for it to go above that day's high before I'm buying it. But I could see some people saying, hey, look, this is a great cost basis, living above 400. Let's go forward a day. So, but if you bought it that prior day, what are you doing this day? Let's just blow that up a little bit more. Like that just doesn't look right. Now you're just hoping. Hope is not a good strategy. Now it's just going lower. Now you're hoping it's going to find support at the 400 day. So, I mean, come on, but what are you going to add more to it? So you're averaging down into that? It's just silly. There, boom. Okay, if you're going to buy it, you're back above your 50-day. You're back. You got support at your 400 Livermore area. Your RS line is back up at its short-term moving average, and you have something to trade against. Boom, and your expectation is that it's going to take out those highs in a blink of an eye. So let's just go forward. End of the week, Not what you would have thought. So this is what you would have thought over here. It's weird that it took a week, but if I sat through this and was able to live through that, which I don't know that I would have, I would have been gassing it here because this is what you're expecting. Like that day, that's beautiful. And we know that it doesn't work, right? Because we've seen this, but you've got to put it in your minds that you don't know that for 821. That looks beautiful. Really, RS line at new highs, gap up, low back above the 21 day. I'm gunning it, It doesn't work, but I'm gunning it. But this is where I've gunned it. The low of that day is going to be my stop. And it's failing at 500. Holding in there. Still never went below our stop. Let's go out a couple weeks. Now it's coming back in. And, by this time you're exiting that because it's not doing what you would have thought. So they don't all work, but that's how you need to look at it. You need your exit strategy is the most important thing of where are you going to get out. Now, over here, it's no longer pulling back into your 50. And keep in mind, now your 21 day is underneath your 50 and your 21 day significantly underneath it. And it's in a downtrend. You want to pay attention to the trend of the moving averages too. Is your 50 day in an uptrend? Well, then you could try this. If 50 days flat to in a downtrend, do you really want to be buying off of a flat to downtrend moving average? No, not really. Let's just go forward, see if there are any others. You know what? Let's not end on a sour note. Let's do one more of those stocks. I know we're gone a little bit long. I don't remember how these look. Oh, let's do life. And we'll go to current. And this one, because I'm so mad that I mishandled it by not realizing what they did. And they make those little tile devices. And I've got a ton of those. I've got like 20 of them, like little trackers. I don't have any handy, but it's something good to have in your wallet. It's I do have one in my wallet here. These things, look at that. It's tiny. And then if you lose your wallet, then you've got that going for you. So that's why I was so mad that I missed this, because I didn't realize what they did. I just didn't have time to research it. But let's look at this. Comes into the 21 day over here on 623. Let's go over there. So this is normal. Your 21 day moving average is well above your clear pivot out of that consolidation, and 48 was kind of your real pivot down there. So it's well above that. 21 days above your 50. Your 50 is in an uptrend. Your 200 days in an uptrend. And you have a shakeout underneath there. So I'm going to be buying it on this day. Yes, I know it's down on the day, but it doesn't have to be up for me to buy it. And it went back through your 21 day. And so let's see how that plays out by the end of the week. It's held above it, not ideal, but it's still held above it. And so I'm looking at the high of that little downside reversal to add to it. And then boom, goes through there, adding to it. But you can tell it's a squirrely trader. These days, it's not an easy trader. But it's still holding above that. Let's go out next month. Okay, so it came back in and around here. Let's go August 11th. So pulled back in, and again, your 21 days above your last area. It's above over here. Your RS line, yeah, it's come back in, but it's still well above its Grateful Dead line. And so it is looking good. I'm looking to buy it over there because you've got a closing range of 26. My expectation is for it to come down and test out any stops are at the low of this day, certainly the low of this day. So 72.59 is where I'm thinking it's going to come into. But the next day it just gaps up. So then I'm going to have to just be buying that. And that's how I would, stretch and buy it through there and probably adding to it throughout the day. And so, I didn't do that, but I should have done that. And I didn't do that because I didn't understand what it was. I think I just saw life and I thought it was like I don't know what I thought. Maybe it was a gym or something like that, and I didn't see Planet Hollywood or Planet Fitness doing well, and I was just wrong. So you've got to own your mistakes, and then let's reset this to today, and boom, it's up there. And that's why I've got to budget my time a little bit better. But sometimes it's impossible. So with that said, this was another Webby Rambles On, back to the beginning or back to the basics. They're not always going to be this short, and I'm not always going to not go off on tangents. I'm going to get back to those. I know some people hate that. The point is of this whole series is I'm doing it to leave it for my kids and future grandkids. And so a lot of those stories are just pretty much for them, and hope that, but being hopeful that it can help other people. So I'm going to get back to that. But I have a few more of these that I want to get through between now and the end of the year, because I've got a lot of traveling I'm doing. And I am speaking at I don't know when I'm going to release this one, so it might be after these events, but I'm going to be speaking at a meetup group in San Francisco that they were nice enough to invite me to on September 27th. I believe it's on the 27th and 28th. I'll be speaking on the 27th. Charles is going to be doing a Q&A on that Sunday. Unfortunately, I'll be flying back home, so I'm not going to get to watch that on Sunday, but I'll be there on the 27th and going to be going through a live walkthrough of the Quicksand and Grateful Dead. So you can look on my Twitter handle, mwebster1971, and I've retweeted Hans's info on that in case Hans is the meetup leader there in San Francisco. Now, the following week, I'm doing an IBD event. Hopefully anyone who has the ability to go see that can come see it. It is a paid event. And I'm going to be, at the end of the day, our good friend Arusha is going to do a Q&A with Chuck and I. That'll be the first time we've been on stage in years and years and years. We used to travel around the country and do chart schools together and market schools together, and really miss those days. Of course, Justin would travel with us and we were a team. And, it was really the three of us, and that was a special time. So this will be a lot of fun. So I don't know what we're going to cover, but whatever it is, I'm looking forward to it. And then on the 18th of October, I'm going to Matt Caruso, who was on one of the Webby Rambles On. Super nice guy, super smart, highly intelligent dude. Well, I don't know how smart he was because he invited me to come talk, but I'm going to be talking at him and a buddy of his are putting on a workshop in Fort Lauderdale, Florida that weekend. And so I'm going to be talking on Saturday. And then on Sunday, a real market wizard, Jason Shapiro, is going to be speaking, and I can't wait to hear him. And he was nice enough to allow me on his podcast a few months back, and catch that if you can. So anyways, that's what's going on the rest of the year. And I've got a lot of other travel. So that's one of the reasons why I'm doing these short ones, just because I don't have time to record so many. I'm trying to get a bunch of these in the can. So not sure, maybe I release this in November. I have no idea. But anyways, hope this was helpful. Now, your tuition, as always, is to go out and be kind to somebody, something, an animal, an insect, anything. And just the more kindness you put out in the world, the better. And do it when no one's looking. You don't have to make a big old thing out of it. Just do it and get in the habit of just doing the kind gestures out there, and let's get the karma going for everyone. So anyways, with that said, peace out, guys.